Why is understanding the value of your business or company just so important? My name's Andrew Maxson, and I'm one of the partners and accredited appraisers at Intellect Business Valuations. Today in this video, I'm going to be running you through these bullet points here, which is explaining Intellect's Valuation Road Map. The Valuation Road Map with Intellect is centered around valuation of your business or company, typically being a privately held business or company, and we work through key valuation issues and how they can be used to your benefit to achieve your goals and objectives for you and your business. So why is it so important to understand and know the value of your business? There's basically two reasons for this, and one is the impact it has on you and your business here and now. Possibly more importantly is the impact that it will have on you and your business in the future or the years to come. When we perform a valuation, we look at the good and the bad, the pros and the cons of your business. So by having a good solid understanding of the value of your business, this enables you to perform or make enhanced decisions leveraged around the value of your business, which can impact daily decisions, along with longer term decisions, such as deciding if, when and how to make an exit from that business, along with things like minimizing taxation payable to the IRS. Valuation and the timing of it is imperative because leveraging the right techniques to come up with a defensible opinion of value at the appropriate time can either increase or decrease value, and if managed appropriately, can do so in your favor. So to the second bullet point here, we have both formal and informal opinions of value. For the more formal, think of things such as for litigation or to provide a value to the IRS, very much where it is mandated that you need to get a formal valuation performed or given by an accredited appraiser. There's also the informal valuations, which is what we're talking about today, where effectively valuation is used as a tool to make strategic and planning decisions, again, both for the here and now and for the years to come. Effectively, through the Valuation Roadmap with Intellect, we will be running through all of these key issues, considering them and explaining their importance to you and why and when exactly valuation should take place, again, to achieve your goals and objectives. We go through this process with you with Intellect's accredited appraisers, where we deliver both those formal reports I mentioned earlier, but also the informal planning reports, which we will speak to more in the Valuation Roadmap. On the next slide to come in the next video, we will have a further look at exactly what is in the Valuation Roadmap and how we customize this for you and your business to get the best outcomes. Now, at Intellect, we value businesses for a range of purposes, and the reason that I'm saying this is that valuation and sufficient planning are not mutually exclusive obligations or things that should be considered. By this I mean that yes, we value businesses for a transactional purpose, but there's also many potential transactions, and proper and adequate planning leading into a transaction is the best way of getting the best exit for you and your business. So I'll dig into this a little bit more. And at a top level, when we're valuing businesses, there's actually four reasons or four purposes, if you will, that we value businesses for end business owners. One, as mentioned, is for transactional purposes and its many derivations, being you might be looking to sell a business and need a valuation. You might be looking to buy a business and need a valuation. You might be looking at a merger with another company to extract synergies in operation. You might be looking at giving some shares or options to key staff and employees. Many reasons that a business might want to transact either some or all of the shares in a business. So that's valuation purpose one. The second purpose that we do a lot of is for compliance purposes. So that's either taxation or financial reporting. The third purpose, not the greatest in most situations, but a relevant consideration as well, is for litigation rationales or reasons. Think of divorce, think of disputes, things such as this. So typically speaking, You want to plan to ensure you don't get into litigation, but obviously we cannot control all of the variables in life, nor for the business life. So this is a consideration as well. Now, the fourth and final purpose that I'm going to speak to today, which is primarily what we focus on in the Valuation Roadmap, is for strategic planning or internal purposes. So as I say, that's very much the core of what we're looking at in the Valuation Roadmap and what I'll be speaking to further across this slide and the slide to come. And effectively, the crux there is that this planning or for internal purposes is an informal way of assessing your business, understanding when to value it, why to value it, to enhance better decision making, both operationally for what you have now, but also considering any future plans and ensuring that valuation is used, most importantly, at the right time and the correct preparation is in place to ensure you can get the right valuation outcome given your objectives. So that's really the key here. And effectively, in the Valuation Roadmap, you work with Intellect, ourselves being independent appraisers or valuers. So we have a very, very strong understanding of fundamental valuation issues across all industries. And then within the Valuation Roadmap, we're able to advise or consult on the optimal timing along with the planning necessary through an informal valuation to ensure the best outcome for you and your business. So as I go over to the next slide here, what exactly does the Valuation Roadmap process look like? Okay, part one. So most importantly here, we will look at and identify the unique circumstances related to both you and your business, and then also your valuation needs. As mentioned, there's many reasons why you might want to get a valuation or how valuation is useful in the operation of a business, much more so than just a transactional purpose. So by understanding your business itself, and by that I mean operationally, both financial and non-financial factors, assessing where its performance and position is at, along with any qualitative considerations based on your business and the industry that it's operating in, is the first step to the Valuation Roadmap. Secondarily, we will then talk about your goals and objectives in future, which may impact the valuation needs that you have. And again, there might be valuation needs for a potential transaction, planning for it, some form of litigation, or also taxation compliance, for example, let alone if you have other investors in there and you might have financial reporting constraints, for example. So again, many reasons why valuation may come up within any business cycle or lifespan. So that's part one, an assessment of you and the business. Now, secondarily, we then get to part two, which are some of the key considerations that impact the value of a business, both from a risk and performance perspective. And when we say performance, typically we're looking at cash flow in terms of cash flow available to you as the owner of business, and as mentioned, the riskiness attached with that cash flow. Now, below in the 6 bullet points here, we've got some of the key considerations to valuation, but not only for valuation at a point in time, but these are key considerations in the planning of any business to ensure that these risks, if you will, are managed as you're operating your business. Now, the first one here, which is always a key one, is financial statements and effectively the quality of them. Okay, so in valuation, and equally if you're looking to transact your business in the market, obviously financial information is one of the key data points and key inputs into the valuation process. So if the financial information is not well organized or easy to assess, that makes it incredibly difficult to analyze the business for valuation, and also typically unattractive for potential buyers. Now, worth mentioning something here too, that in particular in a planning situation or scenario for a business, or equally for when we're valuing, for example, a taxation purpose, there won't actually be a transaction. So what are we actually coming up with here? So we're coming up with what we call a market value or a fair market value under a hypothetical scenario where hypothetically you're transacting the business. So again, something like financial statements, their quality, their usability absolutely impacts valuation. And that's one of the easiest things that if we speak with business owners, which we do throughout the Valuation Road Map, one of the easiest things in advance to start enhancing or ensuring that financial statements are of a decent quality to allow analysis both by internal parties, being yourself, and potential external parties, should you get to a point of considering an exit. Next point there, succession plans. So this is what we call key person insurance. Now, in many of the privately held, family operated businesses in particular that we value, there's typically one or two key people in the business. This is quite standard, and effectively what happens then is that a lot of the value in the business can be attached to that person specifically, and this is known as personal goodwill. So effectively, again, if a business is hypothetically to transact or actually transact in the real world, and the owner or the key person sells out of that business and then is expected not to continue operating in that business, there can be risk here that the performance of the business in their absence declines. So there's many ways to prevent that risk or manage that risk or decrease that risk. One option is through key person insurance, but also process to ensure that this person is not so important to this business over a time frame. And again, this is where the planning component of the Valuation Roadmap is really, really useful. Now, point 3 here, size and complexity of the business requiring additional and more complex planning. Now, this is often where other advisors or intermediaries that we work with end business owners come into play. So may they be an attorney with legal advice, a CPA with taxation advice, or possibly a personal financial advisor. As complexity increases, then more planning is required. Now, I'll give you an example at a taxation level, so something to discuss with an attorney and or your CPA. Depending on your net wealth and the value of your business, as we know, there is an estate tax in the US that, depending on which year we're looking at, is somewhere around $12 million per individual, where if net assets are above this amount, there can be estate tax payable. So effectively, once we get to more complex situations, or in this case, net equity or net wealth that is worth more than 12 million, then planning in advance is imperative to minimize the legal amount of taxation payable when estate tax becomes payable. And again, planning is the key word here. For many, many, many of these issues, once it comes to the actual valuation date that matters, for example, in this case, upon a death, planning cannot happen, and thus it is too late. So there's many, many strategies that you may have heard of to ensure that excess taxation is not paid, in particular in this case of estate tax, such as gifting of minority holdings to relatives, beneficiaries to reduce the taxable bill. Again, planning is key here, and as part of the Valuation Roadmap, these are some of the issues that we will assess for you, explain, and then formulate a plan for how best to manage them. Now, I touched briefly there on point 4, and that's around what we call the valuation discounts. And effectively, this is where the value of a non-controlling parcel of shares or a minority parcel of shares is on a pro rata basis worth less than a controlling stake. So this is quite a technical point, but let's say hypothetically that the value of the whole business is $100. What I'm saying, if there's 100 shares, each share on a controlling basis would be worth $1. If there's shares that are non-controlling, so say I own 20% of them and I don't have control with them, well, the value of them will be actually worth less than $20. So this is a great tool that effectively you can utilize when it comes to gifting and minimizing that estate tax. Point 5 here, growth and strategic planning. Now, obviously, by going through the Valuation Roadmap and thinking about valuation, along with point 6 being the appropriateness of exit options, which I'll get to, but effectively by assessing all of this, we can ensure that operationally as well, your growth plans are of a justified nature, if you will, that will enhance cash flow and minimize risk to the business as you grow. Again, a good segue into point 6 here is the exit options for your business. Now, typically speaking, we suggest that all business owners must have an exit plan and exit objectives. Now, this requires a lot of thought and analysis and constant updating and considerations of new facts as well. But as we know, not all things last forever. So effectively, at some point, if you own a business, you will need to consider what you do with that business. May that be give it away to your beneficiaries, sell part or 100% of it. So again, planning around this is imperative to ensure that your exit options are maximized for what you are looking to achieve. So to what I've just mentioned here in these 6 bullet points, I'll give you a classic example of where we operate in this space. Quite often, through the Valuation Road Map, an end business owner will come to us and we will analyse this situation, explain these factors, and then inherently, the first thing they often do is some gifting to beneficiaries to minimise their tax obligations. Now, under that situation, it is in their best interests for those valuations to be lower to minimise legal taxation paid. So by doing the Valuation Roadmap where we set out all of this, we can talk about the planning to ensure that you do minimise legally and in accordance with valuation standards the valuation as part of this gifting plan. Subsequently after that, we will then look to the future and potential exit opportunities for you in the business, assuming you still retain control. And in that situation, obviously you would like to maximise your business value. So quite a normal scenario where we speak to business owners, the first valuation that we do with them will be the lowest valuation that we execute with them. Subsequently, after enhancements to the business, their valuation increases, allowing them to make an exit at a more optimal level. So that's some of the overview or the framework of the Valuation Roadmap service. Now, effectively, in this Valuation Roadmap service, we will run through this process. And we start that at a price point of $550 to assess all of this relative to your business and spell out what I've just gone through here. Stage 2 to that is doing a more explicit valuation. May that be an indicative valuation, a summary report, or a detailed appraisal report, depending on what we find in the Valuation Roadmap process. If you've got any questions, please come through to me. Would be happy to answer them, and I look forward to speaking with you soon.